when silver and gold are going up, they increase the margin so that people don't buy too much. But now they haven't increased the margin, which shows me that the market is going up. A lot of it is short covering, and they don't want to punish the shorts, so they haven't increased the margins. So I think that's pretty interesting.
Certainly, the shorts must be hurting at the moment on gold and silver because every dollar it goes higher is costing them money. Of course, many of the shorts are technically covered because they'll have gold in London, for example, but they'll be shorted on COMEX. And that's why we had a bit of a problem earlier in the year because of the problem of shipping the gold to meet the deliveries in New York. But but of course, it's never a great thing when you have your physical metal one place and you've got to deliver it in another place because you've got to be certain that you're able to ship it when you have to. Obviously, we don't expect any disruption between London and New York deliveries, but you never know.
The precious metals market is entering its strongest momentum phase in years as both gold and silver extend their breakouts, while margins remain unchanged. Usually, exchanges hike margin requirements aggressively during rapid upside moves, but this time they haven't. An unusual decision that signals the move is being driven mainly by intense short covering. With shorts already under pressure and physical metal harder to source between London and New York, the structure now reflects a market where paper liquidity is struggling to keep pace with real demand. Marioinnecco, a respected macro analyst, and Clive Thompson, a longtime metals researcher, note that the technical structure resembles the early stages of the major late 1970s breakout. Silver's strength continues to lead, supported by backwardation episodes, collapsing ratios, and miners showing far greater upside than their gold counterparts. Meanwhile, gold's flag-based technical setup points toward a decisive continuation move, with some projections extending towards $6,000 in the coming year as global debt expansion, monetary instability, and growing institutional allocation push capital toward hard assets. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
There's the breakout of this teacup and handle, right? But this other line here, I've been following it for the last few years. This one, we broke that last year, and there was a bit of a correction there after the election, and then we've gone back up. I just think this is so strong that I can't see it stopping now. It looks like the chart of the German mark or during the hyperinflation. We had a very similar. So I think it's going to get out of control. I personally think we're going to see 6,000 next year. I think silver is the place to be, even though I'm not selling my gold. But I think in terms of the miners, Clive, I'm leaning more towards having silver mining companies because I think even though the gold miners I think are going to do well as well, they're going to outperform. Yeah.
I did a bit of research for a friend a week ago now on some gold and silver miners, and he named a few stocks. I won't name them specifically because I partly can't remember them now. But the ones I looked at, the silver miners had far more upside potential than the gold miners. I mean, the gold miners were, upside potential 100% easily or more. But the silver miners that I looked at were multiples of that.
Yeah, and this is the gold silver ratio, the one most people look at, and that's breaking down as well. So that's bullish silver, also bullish gold. And there's another chart here because some people might be thinking, gold hasn't broken its old high of 43.80, but if you look at this triangle, Clive, let's put it on the daily. I was looking at this triangle about a week ago, and it might still be, it might still come back. But I think the fact that silver's broken out now is going to be very hard to put that back in the triangle or back in the box, so to speak.
Yeah,
So
if
this looks very bullish.
you could make the flagpole going all the way down to
Here.
3,300. Well, actually,
Yeah.
if you put the flagpole under the upper diagonal line and go straight down to 3,300,
Yeah.
you've got a perfect flag pattern there.
Yeah, that's so two four so that's about 3,000, it's about $1,000. So if you add $1,000 to 4,200 or 4,170, well that's like 5,200. And that's very, that's the objective. And this took what, August, end of August to end of October, mid of October. So we could be by January, we could be at 5,200. So that's pretty
Yeah.
exciting, but it's going to get a lot choppier, don't you think, Clive? People need to have a strong stomach.
Yeah, I think for those who haven't got enough gold or silver, and obviously maybe there's a little bit of panic because they don't feel they've got enough yet, I think the way to play it is to buy a little all the time. So, and it doesn't matter whether you pay more or less than you previously paid, but if you ease it in, you know that the long-term direction is going to be higher, because almost certainly because we've got higher aggregates of everything from money supply to government debt to stock market. It doesn't really matter what you look at. Everything is, they're printing money like there's no tomorrow, effectively. So everything's going to be higher, and gold probably will go with it. So
Yeah.
if you gradually buy, of course, you'll have some bad days when you buy, and you have some good days. Sometimes you pay too much, and sometimes you pay too little. Don't throw it all in on day one, because if tomorrow, and I don't think this will happen, but if we wake up on Tuesday and it's gone down $50, it's really going to hurt that you put all your money in on that highest price.
Yeah.
You'll feel much more comfortable easing it in, maybe one third now, one third in a couple of
Yeah.
weeks, and one third in a month and a half.
Yeah, dollar cost averaging. Yeah, I mean that's what I try to do. Or it's not every time that I have the spare fiat to buy gold or silver. So will the COMEX. So everything, as we said, is moving to the east because they are actually trading the real physical metal, and I think the paper game is over, Clive. For gold and silver, and the world's going to change. I think hard assets are coming back to the fore, and we haven't even seen, Clive, investors place that much of their funds into gold and silver. It's still under-owned, don't you think?
I believe, and I was checking today, I saw a figure mentioned of somewhere in the range of 0 to 2% on average. But some firms have now come out and said that the level of gold should be much higher. For example, which was the firm which said we should now have a 60-40-40 portfolio? Let me have a look. That was Morgan Stanley, the chief investment officer of Morgan Stanley.
Yeah, 60,
Says
20,
that,
20, right?
yeah, it's now gone to 60-20-20, with the 20% being in gold, i.e., half of the bond allocation.
Yeah.
We've also had Standard Chartered come out and say investors should have, I think it was 7% in gold, if I'm not mistaken. And what else? Ray Dalio has said investors should have 15% in gold.
Mm,
But it's still thin on the ground in terms of
yeah.
institutions putting gold into their asset allocation. It's not really there yet.
I think Morgan Stanley is going to be in the next few years. That's going to be the downside limit. I think people are going to hold almost, 30 or 40. That's what the central banks are going to do, in my opinion. Someone asked Clive, because silver had been in backwardation for 2 months, which means that the spot price was higher than the futures price, and now it's going into contango. What does that mean? I think it means that the shorts are panicking and they're covering their futures. So yeah, and the price is going higher. So yeah, what do you think that means, Clive?
I've seen it happening that we are in genuine backwardation, particularly on the near months. That basically means the futures price, which should be higher than spot, is actually trading below the spot price. That seemed to have reversed itself recently. I haven't checked in the last few days.
Yeah.
But the other thing I'd actually caution people when they do look at this, make sure you're looking at the same timestamp for the
Yeah,
futures
that's
and the
right.
spot market, because sometimes the futures are closed and people, because they close earlier than spot, and then people are comparing the closing price of the future with the spot price an hour later or 2 hours later, which can give a false impression sometimes.
Yeah, the futures price, let's say for December, a few weeks ago, the December price is not a front month, so it doesn't trade regularly. So the prices don't really update. Like I think March silver is the front month. But anyway, Clive, where do you think silver is going to open tonight?
I think, given the momentum we saw on Friday, I think it probably opens a lot higher. I don't want to put a number on it because I'm going to be wrong, whatever the number is.
Yeah,
But let's just say I think it will gap,
gap up. Yeah, yeah. And
which means you
apparently
have
they
empty
haven't.
space.
The other thing I've read, Clive, is a lot of times when silver and gold are going up, they increase the margin so that people don't buy too much. But now they haven't increased the margin, which shows me that the market is going up. A lot of it is short covering, and they don't want to punish the shorts, so they haven't increased the margins. So I think that's pretty interesting.
Well, we'll see. I mean, certainly the shorts must be hurting at the moment on gold and silver because every dollar it goes higher is costing the money. Of course, many of the shorts are technically covered because they'll have gold in London, for example, but they'll be short on COMEX. And that's why we had a bit of a problem earlier in the year because of the problem of shipping the gold to meet the deliveries in New York. But of course, it's never a great thing when you have your physical metal one place and you've got to deliver it in another place because you've got to be certain that you're able to ship it when you have to. Obviously, we don't expect any disruption between London and New York deliveries, but you never know.
The latest surge in silver has pushed the metal firmly past previous resistance levels, breaking through the mid-50s dollars and confirming that the recent advance is not a double top, but a continuation of strong underlying demand. The sharp green candles and clean gaps seen after the futures outage revealed how much upward pressure was sitting beneath the surface once the usual suppressive mechanisms temporarily disappeared. At the same time, the broader macro reset is becoming evident through ratios like the Dow-to-gold ratio breaking long-term support, highlighting a shift toward hard assets as government debt marches toward unprecedented levels. With projections placing gold near $5,900 within a few years, and silver's technical structure aligning with that directional trend, the market appears to be transitioning toward a new pricing regime in which physical assets reclaim dominance from financialized paper contracts. Now, let's get back to the interview.
But you look at the mainstream financial press and other press, there's very little talk about silver, which I think is encouraging. What's your view?
I think the high point was $56.72. I'm
Let's
not
have a
sure if that
look on
was
the spot.
not sure if that was on the spot of the future, but that's
This
the
is,
figure I
says
saw.
here 56.54. This is the spot.
Okay, that was the high point on the spot.
Yeah, and we
You know,
closed, I think, at 50. It's here the close 56.40 basically. So
yeah, okay. So, what, the previous peak, I think, was a few days ago, or whatever it was $54. And then on Friday, we just had this sudden, when we actually saw a proper price, because unfortunately I was looking at multiple prices, which didn't make sense at times. But when I did see it, seemed to just gap up, like there's a gap,
yeah,
like an empty space.
yeah. The high in October was 54.48. So we
Okay, so
we
that
went
was the peak we went
comfortably up.
through.
Yeah, I mean, we had that high, I think it was October 16th, and then we had that big correction, which looking at a monthly chart, you can't even see it. But let's do it as a daily chart, then you can see.
Yeah.
So that was the old high here. Let's see, 54.48, yeah. And then we had the big correction. We went back up and down, and now, I mean, this looks, a lot of people were thinking that this was going to be a double top, and that we're going to break here and then go back down to 37. But I think that's been negated now.
Yeah, I mean, I have to say I was surprised, but when you get surprised, it's usually an extremely bullish move, and you can see the strength of that move up. It's a very strong,
Yeah.
long green bar. And as I said, I think this was in some way reflecting the fact that suddenly people couldn't trade the futures. Therefore, there was nobody out there to suppress the price on the futures exchange, pulling down the spot price, and silver found its true price.
Yeah, and even the few days before it, it was doing quite well. So anyway, let's oh, I got a few other charts. That's the Dow gold ratio. That's another important thing. Someone asked about the reset, financial reset. This is part of the reset here, the Dow gold ratio. And a lot of people think that we're going to go back to 1 to 1. So the price of gold, you will need 1 ounce of gold to buy 1 Dow. And I think that's possible. In 1980, it went down to 1 to 1. In 1932, it went down to 2 to 1. And we've broken really key support here in the Dow gold ratio. It went down to like 6 in 2011. And we've had like this top, and now I think we're going a lot lower. It's a bit sticky, this ratio, but I think eventually in the next 2 years, we could see it at 1 to 1. And that is a reset, don't you agree as well, in terms of financial reset, not a digital currency reset?
Well, it's certainly silver and gold returning to their true value to reflect the generalized rise in other assets. I
Yeah.
mean, we've seen, and I've got a chart. Maybe I can show it to you. If I can I share a screen with you, Mario?
Yeah,
It's of the.
let me allow you to share.
This is showing the U.S. government debt against the gold price since 1971. So we've got the gold price on the right-hand scale in sorry, the left-hand scale in dollars on a logarithmic scale. That's the red line, and we've got the U.S. government debt, which is the area chart with on a logarithmic scale on the right-hand side. So back in 1971, the U.S. government debt was 38 billion dollars, and now it's $37 trillion, about 100 times as much. And if you look at the, whoops, if you look at the, I'll go back. If you look at the blue line, the straight blue line, that's sort of a line of going through all the middle points roughly. That just shows the trend we've had, almost a straight line up in government debt on a log scale. Obviously, it'd be curving upwards if it was not a log scale. And we can see where the government debt goes to. It should be on this line by 2050, $320 trillion.
Yeah, Clive, just a little correction, and sorry to interrupt. The debt in 1971 was 398 billion, not 39 billion.
So I got that figure. I got that figure from ChatGPT actually. So maybe it's wrong.
Or maybe you missed a zero, I don't know.
Yeah. So anyway, but just projecting forward, if I put the gold price on the same line, I see that by 2027 we might be, and this is obviously speculative here, if gold follows the rise in government debt, we might be at 5,900.
Physical silver centers by 2030, driven by DMCC's infrastructure push, new trading tokenization platforms. Yeah, I agree. That's what I'm hearing as well. Uh, and I think it could be before 2030, personally. Anyway.
I've never been to the gold market in Dubai, been to Dubai, but not the gold market. But it wouldn't surprise me if they don't develop a silver market too.
Yeah, and that's what I'm hearing, Clive, that they're gonna be like BRICS want the Chinese want them to run the silver market, and the Chinese will run the gold. So that's what I'm hearing. And unfortunately, yeah, and maybe that's why, we don't know yet. Maybe that's why JP Morgan is sending some of their bullion traders to Singapore because they want to be in the heart of the action.
The momentum across precious metals continues to build as structural signals confirm that both gold and silver are entering a far stronger phase than most expected. Silver's breakout above its previous peak, despite volatility, margin dynamics, and futures market distortions, reveals how aggressively underlying demand is rising. The rapid rejection of the recent double-top narrative and the powerful recovery candles show that actual market value is beginning to surface as physical flows overpower paper market influence. At the same time, long-term ratios such as the Dow to gold breakdown, accelerating central bank diversification, and the ongoing shift in price discovery toward Eastern hubs all point toward a maturing global reset. With projections extending toward $6,000 gold in the coming cycle and silver still positioned to outperform, the broader trend continues to align with tightening supply and expanding monetary stress. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.